Good afternoon, everyone, and welcome to CohnReznick's webinar, Federal Tax Update for Manufacturers and Wholesale Distributors. First, let us know that you can hear us by raising your hand using the dashboard to the right of your screen. Thank you. My name is Alan Wolfson, and I'll be your moderator for today. I'm the firm's manufacturing and wholesale distribution industry practice leader, as well as the managing partner of our New York office. I have more than 25 years of public accounting, tax, and consulting experience. The experience includes transactional diligence, structuring, operational analysis, cost segregation studies, debt and equity introductions, and strategic tax planning. With that, let's take a moment to introduce you to today's speakers. Our first speaker today will be Richard Shivak. Richard is a director at CohnReznick and a member of the firm's tax practice. He has an extensive background in providing tax services for clients in the manufacturing and wholesale distribution, retail, hospitality, and technology industries. In addition, his expertise includes tax planning, consulting, and IRS examination support in connection with accounting methods issues, including timing, UNICAP, LIFO, Section 199, and the repair regulations. Our second speaker today will be Scott Hamilton. Scott is a partner at CohnReznick and holds a corporate tax leadership role for the research and development group for the firm. Based in the Los Angeles office, he has 15 years of experience as a corporate tax advisor. Scott has significant experience servicing both publicly traded and closely held companies that have operations in multiple international and domestic locations. He utilizes his experience in R&D tax credits to assist clients with IRS and state audit matters. His experience includes a wide variety of public and private companies across numerous industries, including manufacturing, medical and life sciences, software development, gaming, and high technology. As we begin the webinar, we ask that you follow a few basic guidelines. To submit questions, please use the Questions tab in the panel on the right side of your screen. We will be answering all questions at the end of the presentation. However, please feel free to use the Questions tab to ask them as they come to your mind. For those of you interested in receiving Cpd credit for this webinar, please be sure to answer 75% of the polling questions within this presentation, as they will be tracked by our software. An email, including the CPE certificate, will be sent to all participants who answer 75% of the polling questions a few days after the presentation. We will be sending a copy of the presentation along with some additional information to all attendees after this event. Now on to the presentation. In this one-hour webinar, executives at manufacturers and wholesale distributors will get a high level of understanding of the updates to the rules relating to the treatment of fixed assets for tax purposes, including the new rules related to bonus depreciation in Section 179, as well as to the R&D tax credit after the Pap Act and the current IRS audit environment. With that, let's get started with Richard Shivak.
Thanks, Alan. I appreciate everybody listening in today. I'm super happy to be here talking about not only fixed asset issues, but accounting method issues. Just a little bit more about me and my background. I'm a director in the national tax practice with CohnReznick. I've been here for about 1.5 years, and I actually started my legal/tax career at the IRS national office, where I specialize in accounting method issues. And then after that, I was also with the national office of another firm and the consulting side, and then finally here, all totaled about 15 years, all the while specializing in both accounting methods and tax fixed asset issues. So what I wanted to do today, when I'm talking about the purpose, I wanted to pick material that would be as relevant as possible to your industries and also as current as possible. So there are a number of things that came out over the last year in the fixed asset space. There's been a lot of activity. For those of you who've been listening to the various webinars, you know, the tangible property regulations came out, the Pap Act was passed. There's just a lot going on there, and in case you haven't been listening to the news, I wanted to review that information. And then also on the accounting method side, there are some pending guidance projects of the IRS and budget proposals that the Obama administration has. So I wanted to walk through all of these just to get you up to date, and these are things that you should be thinking about in your business as you're doing either fixed asset planning or accounting method planning. So let's move next to the agenda. So where are we going to go today? First thing I want to do is talk about the Pap Act. If you recall back in December, and this is obviously happened numerous times over the last several years, where we're all sort of biting our nails, and Scott's going to talk more in a minute about the R&D side, but I know on my side over the years you're always sort of biting your nails saying what's going to happen with bonus, and in fact in prior years there were instances where the administration and Congress they didn't get the stuff passed until after the end of the year. Well, fortunately this year that all happened before, so I'm going to talk about the Pap Act. I also want to talk about some budget proposals that are pending with the Obama administration that affect fixed assets and also accounting method issues. If these budget proposals were to pass, they could have a significant effect on a company's tax position. So I think they're important to, while they're not effective yet, they are proposals. It's important to know that they're out there so that you can plan around that. And then finally, I want to talk about some IRS updates and some changes that the IRS made that are pretty interesting, and they're going to change the way you do things just a little bit. So that's the agenda, and that's where we're going today. Okay, so as I mentioned a minute ago, excuse me, first we're going to talk about the Pap Act update. Okay, Pap Act. So bonus depreciation. For those companies that have not filed their 2015 tax return, what you need to know is the rule for 15 and around bonus depreciation is not the same as it is for bonus for 2016. So what's going on for this year? Basically, this year is going to look exactly like it did last year. Meaning, if you look at the left side of the slide, you could take bonus depreciation on property with a recovery period of 20 years or less, computer software, water utility property, or qualified leasehold improvement property. Now, what is qualified leasehold improvement property? Qualified leasehold improvement property is property that's over 3 years old. It's improvements to the interior portion of the building. It arises in the context of a lease between unrelated parties. It can't be structural. It can't be an expansion. So it's somewhat limited as to what falls into the qualified leasehold improvement bucket. You get 15-year life on that. So, so that's where we are today. Now, in 2016, Congress broadened the pool of assets on which you could get bonus depreciation. So if you compare the list on the left to the list on the right, you'll see that it still have property with a recovery period of 20 years or less, you still have computer software, and you still have water utility property. What the IRS did was they took out of the bonus section, they took out qualified leasehold improvement property and replaced it with a much broader term, which is qualified improvement property. So here's how I think about it. Qualified improvement property includes those items that constitute qualified leasehold improvement property. It includes things that would constitute qualified restaurant property, qualified retail property, and more. And you look at the definition down below, the significant parts are they took out that 3-year rule I mentioned a minute ago in connection with qualified leasehold improvement property. That's not there. Also, qualified improvement property does not need to happen in the context of a lease. So what is it? You get to take qualified improvement property treatment on property that's an improvement to the interior portion of a building. It's got to be non-residential property, and it does not include the items mentioned below. I want to focus on that third bullet point because the IRS wasn't really that clear. It says that it's got to be something placed in service after the building itself is placed in service. So clearly, this could be a situation where you buy a building, the building's not necessarily in the shape you want it to be in, and you start doing a rehab on that building. Well, what does this mean? Because this is broader than qualified leasehold improvement property, you're going to be able to get bonus depreciation on improvements that you do to that building where those improvements would have otherwise been non-bonus eligible. Just to be clear, those improvements will still have a 39-year life, so you can't get them into the 15-year qualified leasehold improvement property treatment, but you would get bonus depreciation. So that's an awesome benefit that came out of the Pap Act. All right, let's turn now to changes. Oh, sorry, one more slide on bonus. What's important to know about bonus now, so we had bonus that would expire periodically, and Congress now extended it, you could see, for several years. But what happens after 2017 is that it goes down. Rate changes. So in 2018, we end up with 40% bonus instead of 50% bonus. In 2019, we end up with 30% bonus. And then I put a question mark after 2019 because, frankly, it's too far out for me to even think about at this point. And you just never know. We never know what Congress is going to do. What does that bullet point mean below where it says long production period property? So there are certain items that take a long time to build. These are tangible personal property, and the regulations have always sort of been set up this way. Whenever there's been an expiration date in connection with bonus, they've always pushed that date out one more year when you have long production period property. So all these rate drops, will happen 1 year later in the case of long production period property. So everything there is extended by another year. Okay, let's turn next to changes in 179.
Richard, before you jump into 179, I just want to throw out the first polling question, just to the audience to see if their company is currently taking bonus depreciation.
Thanks, Alan.
You're welcome. We'll give 30 seconds and then move on. All right, thank you. I think we have the majority with their responses in, and overwhelmingly, people are taking bonus depreciation, which, of course, we would expect, and glad to see. Richard, back to you.
Thanks, Alan. And of course, there are reasons why some companies don't want to take bonus. There are companies with expiring losses. There are companies that are partnerships that are trying to manage capital accounts. So there are reasons to do it. Every once in a while, I will pick up a fixed asset schedule, and I will see a company that missed bonus depreciation, and it wasn't done on purpose. So just something to think about. It's there. It's a great benefit that Congress gave us. Okay, so 179. 179, in a nutshell, allows us to write off the cost of certain, generally, it was used for tangible personal property. At some point, Congress included the ability to write off a certain amount of qualified real property. So if the Pap Act didn't pass, the limits around 179 were going to drop way down. And that $500,000 limit that you see on the slide, which is the limit now, that would have gone down to like $25,000, and the phase out would have been lower. I mean, it would have really made 179 not very helpful. So thankfully, in the Pap Act, the Congress made 179 permanent at the $500,000 level. We have a $2 million phase out. which means that if you're spending more than $2 million on this type of property, the deduction starts getting phased out. You could use it for computer software, and as I mentioned before, you could use it for qualified real property. What is qualified real property? Qualified real property is generally qualified leasehold improvement property, which I mentioned before, stuff you're doing to the interior space of a building over 3 years old, unrelated parties, pursuant to a lease. It also includes qualified restaurant property. That's where a building is being used more than 50% for serving and preparing food, and also qualified retail property. It also includes the ability to use it on air conditioning and heating units, and these numbers will be inflation adjusted, so the IRS will put out yearly adjustments to these numbers, and they generally do that in a revenue procedure. So we'll look for that next year when we have our first bump up in the limitations. Okay, so that's the Pap Act, and that's what Congress did in the fixed asset space in connection with these new benefits and extensions. So next, let's talk about budget proposals. And the first budget proposal I wanted to talk about relates to 179. So right now, the Obama administration has a budget proposal which, if passed, would expand the ability or increase the ability for folks to use 179. It would increase the maximum expense up to $1 million. The phase-out threshold would remain at $2 million, and they would still index this for inflation. One thing I failed to mention on the last slide, there was a point about qualified real property and the $250,000 limitation. One thing the Pap Act did was it took out the $250,000 limitation for qualified real property. So that means now you could effectively fill up your 179 bucket with qualified real property expenses. Of course, subject to the phase out. So I wanted to make sure you all knew about that. So next I'm going to talk about a budget proposal that involves Section 1031. Section 1031, for those of you who don't use it or know it very well, is a section that allows you to exchange property that is of a like-kind nature and defer gain. So you could basically sell property on the front end. You basically park your money, and then if you meet all the timing deadlines, you can replace that property, and effectively you defer that gain. Your starting point for your basis in the new property is your basis in the old property, plus any cash that you added to the deal. But that's basically how it works. It's a tremendous benefit. A lot of folks take advantage of it. Under the current administration's proposal, however, they would limit taxpayers' ability to defer gain. It would be limited to $1 million per taxpayer per year for exchanges of both real and personal property. So that would be a big deal. That would really take a lot out of the ability to use 1031. They would take away the ability to defer gain on art and collectibles. And I've known taxpayers to take advantage of 1031 for those types of items. And, you know, the bottom bullet point is the reason why. Purportedly, this change would generate $47.3 billion in additional revenue over the next 10 years. So I wanted to mention that, make sure you're aware of that. The next proposal I'd like to talk about, and again, this is just a proposal. So Congress is always trying to incentivize manufacturing and bringing jobs to the U.S. They're also trying to incentivize investing money in areas that are maybe having a hard time. So you think about the new market tax credit, things like that. What this is a manufacturing communities tax credit. They're not 100% sure the way they're going to structure this, but what's going on here, and the idea behind it is, if there's a community that's either expecting to suffer or suffered a major job loss event, and think about things like military base closings or shutting down a large facility, and they're going to lose a lot of jobs. So let's say that's going to happen. Congress wants, if this is passed, Congress would want taxpayers to invest in that community. As I mentioned a minute ago, this is not actually structured yet, and the thinking is that this would be structured somewhat like the new markets tax credit, where you're basically applying to Treasury for the ability to, maybe get investments, from which taxpayers will get credits, or otherwise it might be more direct, where a taxpayer goes in and gets a credit for spending a certain amount of money in that community. I'm not exactly clear. The other thing is, if you look down at the bottom, there's going to be a pool of money. It's not a limitless benefit. There'll be a pool of money, and it's either going to be, like I said before, something that you apply for, or maybe it will be a first come, first served sort of deal. And so more on that when we figure out how it's structured. It'll be interesting to see where that goes, because it would be a tremendous benefit for some of these communities where they've lost a lot of jobs and where they need a lot of help. And also, what I don't see in here is, what I didn't see is any timeline. So it's not clear whether you could have a closure, like a base closure, and then 3 years later decide to invest in that market, or 10 years later. It's not really clear what the timing's going to be there.
Just going to jump right now into polling question number 2. Quite simply, does your company have ending inventory? All right, thank you. And based upon who we expected the attendees to be, the results pretty much prove out. Over 80% of attendees have ending inventory. Richard?
Thanks, Alan. So, yeah, I wanted to ask that question just to make sure and get a good sense for who's on the line and decide how much to talk about this. So, LIFO, of course, is a benefit to companies in inflationary industries, and it lets you run your higher cost goods through cost of goods sold before your older, lower cost goods. And a lot of companies have been doing this. We have many clients that use LIFO, and the reserve, the LIFO reserve, which represents the benefit over the years, could be millions and millions of dollars. And, every year the benefit, could be a couple $100,000. But over the years, like I said, it's adding up to millions and millions, and the thought of LIFO going away is kind of scary. And if you go a few years back and talk about Irs potentially coming into play, and one of the requirements for LIFO is that there's a book tax conformity. And so with all the Irs talk, IFRS made folks think about, well, what do I do? What do I do if I can't use it for book, then I have to get off for tax, and what's that going to feel like? I'm going to have to recognize all this income. And then at the same time, Congress thought, well, I tell you what, if we repeal LIFO, we get, quote, credit for it in the budget, as opposed to if it just happens and folks come off LIFO, we don't get credit for it. So for the longest time, there's been a proposal to repeal LIFO. It's still there. I just want to let you know about that. It's always possible that it'll happen. I wouldn't say it's imminent, but if it does happen, the way it looks like it would work would be you would be forced, companies on LIFO would be forced off LIFO. But one potential, silver lining, or maybe something to soften the blow, is the fact that Congress would allow taxpayers to recognize that LIFO, that LIFO benefit into income over a 10-year period. So, again, it's just a proposal. I want to let you know about it, and, just watch the news and see what happens with that. The next budget proposal, I should have changed the top of this slide. It shouldn't say LIFO, it should say LCM. But what LCM is, it's lower cost of market. For tax purposes, it should be slightly different than book lower cost of market. But what it allows taxpayers to do is write down inventory based on what market is. And this has been one of those methodologies that for some reason Congress just hasn't liked, and it's been on the chopping block for a while. So these proposals, and in fact it's not only lower cost of market, but it's the ability to write down subnormal goods. These write-downs reflect deductions, and if you don't get the deductions, you get stuck reducing your cost of goods sold and increasing inventory. So this is just another one that's on the chopping block, and I wanted to let you know about that. Again, this is not an imminent thing, just something that's been in the budget, and I just wanted to let you know it's there in case you didn't know. So in the last several minutes I have, I just want to talk through a couple of IRS updates. The first one is, so last year the IRS put out RevProc 2015-14. RevProc 2015-14 has about, I don't know, about 200 automatic accounting method changes. And the way the IRS came up with that list was they saw the types of accounting method changes that would come into the IRS, and they decided at some point, well, I'm comfortable with these, so we don't really need to look at these, and they made those automatic. And then there are others where, they're not so comfortable, and they left those as not automatics. Now the list was really long, and I just want to let you know that in the RevProc, they changed the list. For some reason, they changed certain 460 accounting method changes. Some depreciation changes are now non-automatic that used to be automatic, where a taxpayer has taken a credit, like a rehab credit, and now they're changing the characterization of the property. Those are just a couple of examples. So that's the change to the automatic accounting methods. Announcement, I'm sorry, go back one slide, please. So at the bottom of that last slide that I was just talking to, there was an announcement that the IRS put out, 2016-14. The IRS published a new Form 3115. A Form 3115 is what you use to change your accounting method. And the form came out probably back in December or January, and it was effective immediately, except folks had prepared these changes on the old form. So the IRS sort of informally said, well, you could use the old form for a while, and they never really put an end date on that. So what this announcement does is it puts an end date on that and clarifies that if you're not submitting your accounting method changes now, effective April 18th, on the new form, the IRS will not accept that. So it's something that's important to know, because if you're going to change your accounting method, you need to make sure it's on the right form. So the next topic I want to talk about, tangible property regulations. I was at an American Bar Association conference, and a member of LB&I was there. They are working on an audit techniques guide, just like they have for R&D and for cost segregation and some other areas. That will be a roadmap for the IRS agents to examine the tangible property regulation changes. Now, they didn't say much about the methodologies or way the audit techniques guide will look. The only thing they really mentioned, or that's important here, is that, when this thing is done, I think it's going to be go time for the IRS, and you're going to start seeing examinations around the tangible property regulations and see it happen more frequently. Not that folks should be scared from implementing the regulations, but they just want to make sure that they have their documentation, all together. It's just like R&D. If you're going to take an R&D credit, you want to make sure your documentation is top-notch. So I just want to let you know about that. Next, I want to talk about a couple of things that relate to manufacturers on the priority guidance plan in my last minute. So the priority guidance plan is just a listing of things that the IRS is working on. Two things that will affect manufacturers come to mind here. One is Section 199, and if you see the bullet point saying that it will affect benefits and burdens of ownership, currently, a taxpayer, so let's say there's a co-packer, co-manufacturer relationship, you might be the taxpayer with the IP, the intellectual property, but not the factory. And it's possible now for that taxpayer without the factory to actually take the 199 deduction. Sometimes they have benefits and burdens and sometimes they don't. It's a facts and circumstance determination. In the new guidance, or rather the proposed guidance, the IRS would really turn off the ability to use benefits and burdens in that situation, and they would say that the folks at the factory always get the 199 deduction. That would be a big change. Obviously, some people lose in that scenario and some people win. So keep an eye out for that. That's going to be a big deal. The IRS, just below that, is going to broaden the use of 199 for computer software. And I'll end on this one, which is a biggie. This is 263 Cap A. There's a proposed methodology out there that's going to change the way the absorption ratio, your unit cap percentage, is computed, and it's going to change it in a really favorable way. And if you think about a fraction, what it's going to do is it's going to allow you to put a ton of costs into the denominator of that fraction, which will drive the percentage down. And I think it's going to give companies a really great answer in the unit cap space. We would expect that guidance, in fact, both sets of guidance, 199 and 263 Cap A, would come out over the next year. So more to come on that. So with that, I'm going to hand it over to Scott, who's going to talk about the R&D tax credit. Thank you.
Good. All right, everybody. My name is Scott Hamilton, and I'm a partner here at Cohn-Resnick. I'm a new addition. I'm the practice leader for the R&D credit group, and I'm really happy to be here to help folks understand a little bit more about the research credit. So we have an agenda here for my part. We'll talk a big picture. The research credit, I'd imagine some of you may know, is incredibly complicated. So my job is to try to keep things as easy to understand. So we'll go over the overview, a little bit about documentation. What does that mean? Use of estimates. We do also have a legislative update. I'm very excited to announce that perhaps my legislative updates are coming to an end because we now have a permanent R&D credit, which is kind of exciting. We'll talk a little bit about a particular regulation update related to software. Finally, we will touch on some state credit thoughts, other tax saving opportunities, and how do you actually approach the research credit? And so we'll go over to our next slide. So what we have is what is R&D? So this slide here essentially answers that question. So I'd like to say that if you have smart people working on neat things in the United States, you're probably doing what's called research and development. Nowhere in the law is it required that you have to have an R&D department. While that may help, nowhere in the law does it require that you have to have a bunch of PhDs running around in white lab coats. That's not required. What's required is this here. On the top left, we have, what are you trying to accomplish? What are you trying to do? We're trying to, create a new product or create a better quality. It's going to have new materials. We're going to make something better or create something from scratch. Okay, all right. So if you look at the top right, you ask yourself, well, was that easy? Well, no. We had technical issues. We didn't know how to get the two materials to work together. We were fairly confident we would do this, but at the beginning of our effort, we had a lot of technical problems, whether it's software, which is allowed, or a product, or even a manufacturing process. Think of automation. If you're automating your manufacturing process or parts of that, that's qualified. So if you look at the bottom left of that slide, you'll see the technological in nature. All that's really saying are the efforts that you're doing, are they using principles of science? And so, for example, The IRS, the law is really looking for hard science, engineering, physics, mechanical engineering, computer science. So that's the part where you don't actually have to have a PhD. Again, it helps, as Rich mentioned earlier on the call here today at the webinar, documentation and what you can tell as your story, that actually helps. So on the bottom right of that slide is the process of experimentation. So you have to be able to identify more than one alternative, is what they call it. You have to have some kind of process to go after your uncertainties. So if you've got a software development lifecycle, you have a process. If you have a product development lifecycle, you have a process. If you say, look, when we do development work here at the company, first we design a drawing, and then we design a prototype, and then we test it with this test, and then we go over here. You have a process. So big picture, if you've got people doing this activity that you see here, you have what's called qualified research activity. And then it's just a function of how much money, how much credit are we really talking about. So I think we have a polling question coming up.
We do, and polling question number 3 is, what percentage of your company's development efforts are performed under a contract with your customers? All right, thank you. It is pretty spread. It looks like about a third are saying less than 25%, a third are saying it's not applicable, and the rest are 25% and up. So it looks like the vast majority are not under contract with their customers for development efforts. All right, Scott.
Great, thank you. So really what that question is saying is, if what I call IRAD, if you have internal research and development, you're basically paying for your own R&D. Great, that's fine. However, if your development that you're doing is under a contract with, for example, the state or the federal government, you just have to be careful that you're not. There are certain exclusions in the research credit law, one of which is related to this concept called funded research. And so you essentially have to be, the one who takes the tax credit, has to be financially at risk. Now that makes sense. You shouldn't take a tax benefit if somebody else is paying all your bills. So one of those tests is, are you financially at risk? And the second of those tests is that you would need to retain substantial rights. So for example, if in the contract that you may have, if you are signing away any development efforts that you've come up with, and in terms of the patents and all that intellectual property, and your client would then get to have all of that, well, that's not substantial rights that you retain. And so again, you would have to be financially at risk, meaning you might not get paid for the development efforts you're doing. That's a positive scenario. And the second one was you retain substantial rights. We have a couple of court cases that I didn't put in the slide deck here because they're pretty thick, but Geosyntec and Dynetics have added, they're fairly recent court cases, and they've added a lot of clarity in this very gray area as it relates to funded research. So let's move on to the next slide, and we'll talk about some examples of qualified activity. So again, new and improved. So if you're designing new products, I'd like to ask the question to clients. I say, hey, have you improved your products at all, ever? Well, yeah, of course. I mean, we've got it's faster, it's cheaper, it's quicker, it's better in so many ways. Oh, well, then you're taking the tax credit, I'd hope. Well, no, I don't have an R&D department. So you got to see that you don't have to. Modifications to meet government regulations is an example. Designing a new process for production of a new product, that's very important. Creating specialized tools or jigs or fixtures or machinery using new technology. Using robots for automation that are previously done by humans. And then I think we've got manufacturing efforts to support the new product development. So for example, you may have a new product that you came up with, but you may not have a way to manufacture the product. Again, in the United States, but you might have two opportunities there. So let's move on to the next slide. Considering new technology from a third party to see if it works within your manufacturing outfit. Developing product improvements to increase shelf life. Think of foods. Software. Software is qualified. There are two types of software in the world, essentially. Software that's written that you sell or you lease or license, and software that you write and you use to do your business. That last one would be called internal use software. Barring a couple of qualification tests, both software development efforts are qualified for the research credit. Remember those 4 tests we talked about. But core engine development, algorithms, if you've got software developers or if you're paying significant dollars for software development, think of mobile apps and things like that, that would definitely be qualified. If you're pharmaceutical and you are developing new drugs or you're in clinical trials, obviously that would be qualified. And establishing a new factory where new technology is used. So let's move on to the next slide. As I mentioned, mobile applications, online application purchases, the microtransactions, we've all seen them. Little games on our phones, and for $1 you can get 10 more coins or something like that. Well, that is software as an example that would be developed. Integration software from hardware for new and improved ways for to produce more realistic graphics. Another component here that's often not really talked about is the last bullet point. So everything that I've been talking about so far is really focused on the concept of applied research, meaning research to apply to our particular product so that you can make money. But some taxpayers do basic research, just raw research. We don't even know where that's going to go. Is that eligible? Yes, it is. Basic research is also qualified under Section 41. So those are some examples of what is qualified. So now let's look at the next slide, what perhaps is not necessarily qualified. So, and I think some of these kind of make some sense here. For example, training. Okay, training your people to use technology is not research and development. That's training. It's very close, but it's training. Basic data collection or your typical quality control for manufacturing. That would be considered outside the realm of research and development. Research after commercial production, really what we're looking at is development efforts up to a point. Once you reach functional and economic requirements, then you stop, and then you're manufacturing the widget. Now, if the widget gets kicked back into the R&D group, if you will, for new functionality or new improvements, you might have R&D activity again. But there is a line in the sand. You can see reverse engineering, otherwise known as duplication. You should not be able to, go down the street and, buy your competitor's product, take it all apart, figure it out, and clone it exactly and take the research credit. That's not fair. But if you have new functionality, the rules do allow people to actually look at competitor products. But if you have new functionality, if you've got, it's different in some material way, you can point and say, yeah, mine is not like that one over there. I may have looked at that, but mine is different. I had to come up with all this new stuff. Well, then that's not duplication. That's a new product. That's what the IRS calls a new business component. And so, as you can see also there, research is not allowed. You cannot take the credit for activity that's done outside the United States. So, case in point, you may be a software developer, and a lot of software developers outsource that to India, Korea, Russia, Uzbekistan, wherever. That's fine, but that activity and all that effort is not eligible for the credit. So think of it as a U.S.-based activity credit. I mean, this whole thing is basically a jobs credit. The more people and more spend that you do in the United States working on awesome technology stuff, whatever you want to define it as, even simple stuff, that's what this opportunity is for. And so social science, arts, market research, that actually is not allowed. What I like to call the Coke versus Pepsi test. Does this one taste good or does this one taste good? That actually is not allowed. That's basically market research. However, there is a component in the regulations that say that, part of that taste, as long as it doesn't taste metallic, for example, well, that's a technical research function as opposed to which one do you prefer. So there is a little bit of a fine line there. And you can see funded research once again. So those are some examples of what's not qualified. So we have three primary costs. Wages, supplies, and contract research. Wages, very simple. Box 1 W-2, it's basically wages or remuneration subject to withholding under Section 3401A. That's it. You're not allowed to throw in 401k, the fringe benefits, and all that other stuff. You can use that to kind of gauge your credit estimate, but at the end, you need Box 1 W-2. Supplies, you can see any tangible property other than land or improvements to land, or property that's subject to a character for depreciation. So really what this is looking for is prototype costs, building a pilot model, parts and equipment and chemicals used in the development effort. Contract research. So money that you spend to a company out in town to help you with your research and development efforts. So they, in theory, would hand you an invoice for their work that they did on your research and development project. And let's call that invoice, $10,000. 65% would be eligible to be considered for this cost. The 35% that's been removed, Congress essentially thought, wait, the contractors, they're going to put in their hotel costs and their rental cars and their airline tickets and food and all this other stuff. That's not the research that they were after. And so they just kind of took that and said 35% no, 65% stays. All right, let's go to the next slide. So this is exciting. For the first time ever in December of last year, and I was floored, the research credit is finally permanent. After all of those years of extending it and going back and retroactive, we have a permanent federal tax credit, thanks to the Pap Act. There's also a few other adjustments we'll talk about in a moment that came out of the Pap Act that Rich hinted at. And specifically, the credit goes back 1 year, but it carries forward 20 years. And so you have a lot of companies out there who may not be in a taxable position this year, but maybe in 2 years they'll be taxable. So here's a thought. Gathering the data and the expenses and talking to the people at your company and understanding where the documents are, that could go away, meaning they might not be around in 2 years. People come, people go, documents can be found, some cannot. But if you sense that your credit could be large, but you decide, nah, I'm going to hold off onto this thing for a while, keep in mind that you might have a really tough time documenting your credit or talking to the historians who know all about the technical development efforts. So that's something to think about. Move on to the next slide. Documentation. So when you file the R&D tax credit on your federal return, you don't include any of this documentation. You fill out a form. It's Form 6765. You put all the numbers in there, and then that's it. There is no specific record-keeping requirement for the research credit, but many of us on the webinar probably have heard of this need to document your research credit, and that's pretty clear. You have to identify what are your projects, your business components. Who did you talk to? How does each one of those business components meet those 4 tests that we discussed earlier? How did you identify your qualified research expenses, your wages, your supplies and contract research costs? Which methodology did you use? Did you have an acquisition or disposition, or is there a short year? There's a lot of things that need to be documented in the research credit. Most importantly will be those 4 tests. And of those, say the uncertainty test and the process of experimentation test are probably the most important tests to be documented, meaning emails, technical reports, meeting minutes, agendas, all kinds of contemporaneous materials that you may have and you don't even know it. Time tracking could help. Software developers often use different programs just to write the software. Those tools could be used to identify nexus points, if you will. So that's an important thing to think about. So we definitely in the industry understand that not all taxpayers have these perfect records for every hour spent, but we can couple some documentation to oral testimony so that we can identify those business components and costs and things like that. All right, let's move on to the next slide. So on the Pap Act, we already mentioned that it's made permanent retro for January 1. A couple of enhancements specifically are going from January 1, 2016 going forward, so prospectively. Historically, the research credit could only offset regular tax. So a lot of small and mid-sized companies that had AMT, they couldn't use the research credit. Now, we may have an opportunity here. We're going to wait a little bit to find out how this is going to play out on the tax forms, how you literally file for this. But an eligible small business, essentially a small business is $50 million in average annual gross receipts over the prior 3 years. If you are one of them, you potentially could be eligible to offset AMT with these research credits. Now, research credits generated in 2016. So we cannot take 2013, 14, and 15 research credits, lob them over the fence on the 2016 corporate return and offset 2016 AMT. Another opportunity that you could consider is offsetting employer-side Fica. Assuming you're a qualified small business of less than $5 million in annual gross receipts and you've been in business 5 years or less. So you can potentially offset up to $250,000 of payroll tax, your side of payroll tax. So some actually look at that a little bit and think that if you fit that bill, that could really be a nice opportunity. In the future, we may see that the credit rate will increase for the alternative simplified credit, the ASC. Of course, that would only be better for taxpayers. And that I'm seeing that the regular credit, the old way of computing the credit from this historical base periods and all that other stuff that you may be familiar with, that actually might be done away with, because as we get farther and farther and farther away from when this particular credit was enacted, it might just be irrelevant. So going on to the next slide, brief comments about some proposed regulations as it relates to software. So in the past, the IRS would look at internal use software and had a very old definition of it, and a lot of times software relating to web development and interacting with third parties, that was deemed internal use software, and taxpayers not only had to apply the 4 tests that we talked about, but 3 additional very stringent tests. Essentially what the proposed regulations are saying is that we now see that internal use software is limited to software for providing general administrative functions, financial and HR, essentially back office functions. The old definition of software developed for back office functions is really what is now considered internal use. So what this means is software that's developed to transact with your clients, mobile apps, track sales, progress of shipping, invoices online, things like that. In the past, that was considered internal use. Today, it's not. It's considered just regular software, which is a positive for taxpayers because the threshold or the criteria to meet to get the research credit for the software has now been reduced. So this is a very positive series of events here. And then, of course, we have this concept called dual function computer software. So it's very possible that your software is a little bit of everything. That obviously makes sense. You've got software that is connecting back into the back office and as well as third parties. The proposed regulations say that if you can essentially bifurcate the software between the ones in the back versus the third-party software, you can call the third-party piece not internal use. The threshold is only those 4 tests, and you potentially could be qualified for more activity, more qualified cost, and a larger credit. So the big takeaway with this slide here is that software development has an easier definition when it comes to, quote, internal use software, and taxpayers should really take a harder look at, hey, do I qualify for this now? All right, let's move on. So relating to states and other tax opportunities, many states have corresponding tax credits. So when you're looking at a federal credit, you probably want to take a look at, can you pick up state credits at the very same time? Oftentimes, the state laws and requirements are pretty much the same as the federal law, so that obviously helps. Sometimes you claim the credit like you do for Fed, and sometimes you have to apply for the credit to get in line, if you will, take a number and use up a pool of funds. Sometimes it's a cash refund. Sometimes you can exchange the credit or sell it. Some states have permanent credits and some expire. And so another point down here at the bottom of that slide is oftentimes when a research credit study is done, there's a lot of things that, you're kind of looking under the hood, and a lot of other semi-connected opportunities might pop up. For example, Rich Shebeck mentioned about Section 199 for manufacturers or software developers. So then you might even spring an opportunity on that. Cost segregation, tangible property regulations, bonus depreciation, other completely unrelated state benefits that relate just to raw R&D costs. So when you have an R&D study, it's not just a one-for-one. You could actually uncover a lot of tax-saving opportunities for those that are really interested in that. So I think we have another polling question here.
Yes, we have our 4th polling question. We're getting awfully tight on time, so we're going to ask the question quickly and sort of wrap up soon thereafter. Polling question number 4. Is your company currently claiming R&D tax credits? Very simple question. So it looks like it's split pretty evenly down the middle, with just over 50% saying no and just under saying yes.
Great.
So Scott, I'll ask that you wrap up the last slide in the next 30 seconds, and then I'm going to disclose.
All right,
out.
Next 30 seconds. All right, here we go. So really the way that you would want to approach, if you move to the next slide here, the one that talks about the phased approach on the slide, you really approach the R&D credit, back up one slide, you really approach the R&D credit as a phased approach. You look at it in terms of do you have qualified activity, and do you have qualified cost, and if so, how much? If that number is big enough, then you actually do the full analysis. So you put your toe in the water, don't dive into the deep end, answer a couple of basic questions first, and then if you do have a real opportunity, then it's recommended that you would proceed, because there's a lot of work here. I think my time is up. I appreciate it, and I'll hand it back to Alan.
Thank you, guys. Yeah, we are just at 1 o'clock, so we didn't want to keep people over. We did get some questions that came in. We will send responses out shortly after the seminar, after the webinar. We'll send the questions out to the appropriate individuals. I'd like to thank you all for attending today's webinar. As mentioned earlier, an email including the CPE certificate will be sent to all participants who answer 75% of all the polling questions a few days after this presentation. And we'll be sending a copy of the presentation along with some additional information to all attendees after the event. Thank you again. Enjoy the rest of your day.